saw a record wave of funds making an exit, but you say it remains intact. Is there a sense that perhaps the sell-off is overdone?
That's a really good question, and thank you very much for having me today. So, yeah, as you said, we've had a decent amount of correction, and don't forget that this level of correction was from actually a pretty strong rally as we went into the MPC session, with policymakers surprising the market by announcing that the amount of issuance they were going to do on these new special government bonds was going to be less than the market had anticipated. So following that really strong rally, we've actually had a massive back-off. Now, a lot of the reasons behind the sell-off in yields in China, I believe there's still going to be near-term headwinds. So a lot of it is, the difference between what the policymakers say and what they do. And what they have said is that they'll continue to support the economy with easy policy, but what they have done in recent days is actually drain a certain level of liquidity out of the market, and that definitely has an impact on bond yields in the shorter term. And also, what you have seen in the Chinese economy is a degree of pretty solid recovery. And especially if you look at the recent recovery in China's credit impulse, it would point to some of this degree of yield correction to be right. You can't argue too much against that. But where I have my medium-term conviction really lies in the extent of the correction and how much longer it can go on for. Because now, what you just said was we're back to February levels. We're within spitting distance in long-end Chinese yields of where we were pre-COVID. Does that marry up with the fact that, policymakers still want financial conditions to be relatively easy? They want to lower funding costs and allow easier funding conditions to reach the real economy. And most importantly, the economic recovery in China is still very uneven. The true extent of the unemployment problem that you have in China is yet to be discovered. The severity is still unknown. And most importantly, PPI is still in deflation. So when you put that against Chinese yields that are, again, back to pretty much where they were pre-COVID, I think it offers a very good long-term, medium to long-term value proposition. The only caveat to that, I would say, is perhaps you're seeing a little bit more willingness from the Chinese authorities to use currency together with rates as a way of easing. And so the FX may pose some near-term headwinds as well.
But Amy, there has been disappointment. The monetary easing that the market was looking for pretty much elusive at this point in time. You talk about the yields, 2.85%. Given that circumstances, where are yields headed?
Lower, and I think substantially lower. When you think about the recovery that you've had in the Chinese economy, sure, you've had the heavy industries get back to work, and there is a degree of old-style stimulus that's being thrown at the problem here. But ultimately, what do policymakers want? They want to support the private sector of the economy. They want to support small and micro companies because they are the mass employers of the economy. And in order to do that, they have to make sure that funding costs remain easy. And when a lot of corporate China's bond yields are all benchmarked off of CGB yields, you can't have CGB yields rising relentlessly like this for, let's say, another 30 to 50 basis points without it actually doing damage against what the policymakers are trying to do to support the economy right now.
And Amy, the China bond story, I guess, it coincides with what we're seeing in bond markets across the world right now, where havens are selling off, equities are just abound. And it seems like despite all the technicals, despite the high valuations, markets continue to edge higher. How does an investor get back into this market, and how do you actually reallocate given this type of backdrop?
Yeah, it's a tricky question to navigate here. I think, the extent of the bounce has definitely surprised a lot of people. If the market consensus is still not reached the right letter of the alphabet on the shape of the economic recovery, the extent of the market recovery is already in, and the V shape is clearly very visible. The one thing that I would highlight, though, is that there's a degree of connection between equity markets and the real economy, but that connection is broken somewhat when you look at the composition of major equity market indices and then what really drives the economy. And if we're looking at the U.S. markets, I would say that, the S&P 500 is driven by tech, by healthcare, and by consumer staples. They've all held up relatively well because of the nature of this crisis, whereas the real economy is driven by finance, services, and transportation. All have been hit and hit really hard, and we'll still continue to see, a slow path of recovery in the coming months. In terms of getting back, look, I would say that the volatility is probably still going to stay for a while, and focusing on quality rather than chasing the momentum is going to be key with a medium-term perspective, for your investment horizon.